Hello, today we're going to look at the elements of PepsiCo's 2014 annual report. U.S. companies with publicly traded stocks must provide shareholders with an annual report. The annual report always includes the financial statements, management's discussion and analysis, notes to the financial statement, and the auditor's report. All this was discussed in Chapter 1 of your book. Let's look at PepsiCo's 2014 annual report for these elements. First, you'll notice the reports and financial statements shown in your text are simplified for pedagogical purposes. Annual reports of real companies will look slightly different and be more complex. My goal for you is to be able to read real financial statements to understand companies you may work for or invest in. This is a bit of an art and becomes easier with practice. We'll look at PepsiCo's 2014 annual report to get you more comfortable with this process so that you can participate in the weekly discussions. Annual reports tend to have plenty of promotional messages, pictures of their products in addition to the financial statement and other elements. Form 10-K, required annually by the Securities and Exchange Commission for publicly held companies, contains the financial statements, elements of the annual report, and other required information. Firms like PepsiCo often combine the annual report and 10-K. Management's discussion and analysis of the financial statements cover 27 pages and explains financial result by division, liquidity, and capital resources. The financial statements take up only 6 pages of the annual report Form 10-K, but the notes to the financial statements take up 50 pages. They provide much more detail on the financial statement numbers, broken down into smaller pieces, and about the accounting methods used. The auditor's report is only 1.5 pages long, but very important because investors know that somebody has looked over the report to make sure that they use proper accounting methods according to U.S. rules, generally accepted accounting principles, and to make sure there's enough control over reporting that management can't make up whatever it wants. Now, the consolidated statement of income, aka the income statement, as shown in your book. It's an income statement, no matter what they call it, if you have revenues minus expenses and you wind up with net income. For PepsiCo, there's only one line of revenue, but various types of expenses, some of which are cost of sales, selling, general and administrative expenses, amortization of intangible assets, which you'll learn about in Chapter 9, and interest expense. This leaves us with net income for shareholders of PepsiCo of $6.5 billion for the year ended 12/27/2014. This $6.5 billion will tie into other numbers later. Like when we look at the statement of equity, which contains the statement of retained earnings from Chapter 1 in the retained earnings account, plus a whole lot more information. You will learn more about this in Chapter 2. So the retained earnings section takes that form of the retained earnings statement. It says beginning balance retained earnings plus that net income of $6.5 billion from the income statement, less dividends, 3 types of dividends of $3.8 billion, gives us ending balance retained earnings of $49.1 billion. Ending balance of retained earnings means the sum of all the income Pepsi ever made since its first day of operations minus the sum of all the dividends ever paid out, and this $49.1 billion will tie to the balance sheet. The consolidated balance sheet, some companies call it the statement of financial position, but you will know it's a balance sheet if it has the accounting equation. The accounting equation is total assets equal total liabilities plus total equity, the numbers highlighted in yellow. PepsiCo has total assets of $70.5 billion, which equal, so the resources or assets of $70.5 billion are financed by other people's money or liabilities of $53 billion and the owner's money of $17.5 billion. You'll see cash and cash equivalents as the most liquid resource, meaning you can use it very easily to pay bills, of $6.1 billion at December 27, 2014. We'll see this number again on the next couple pages on the statement of cash flows. As I said last time, retained earnings at the end of 2014 from the statement of retained earnings agree with this balance here from the statement of equity. So $49.1 billion is in the equity section of the balance sheet and on the statement of equity. Now the consolidated statement of cash flows. This explains the change in cash, which, hey, you could have got the change in cash by taking 2014 cash on the balance sheet and subtracting 2013 cash. But the most important thing is, why did cash change? From running your day-to-day operations, which is called cash flows from operating activities. Did cash go up or down because you spent money on equipment? Or did it go up or down? Did you issue stock? Made it go up. Borrow money? Made it go up. Or did you use cash to pay dividends, repay loans, or buy back stock? The most important section to investors of the statement of cash flows, the most important reason they want to know about why cash changed, is the cash flows from operating activities section. Cash flows from day-to-day activities include cash received from customers, cash paid to suppliers, paid to employees, or paid to lenders for interest. This cash flow from operating activities format, starting with net income at the top and working back, is called the indirect method. Cash flow from operating activities of $10.5 billion is greater than the net income of $6.5 billion because not all expenses have to be paid in cash this period. So operations generated cash, which is a good thing because investing activities, purchasing long-term assets and investments, used cash. The numbers in parentheses are cash outflows. And notice we had capital spending of $2.9 billion. Overall, we bought more property, plant, and equipment and investments than we sold, and cash flows from investing activities were negative and had a balance of $4.9 billion at the end of 2014. Cash flows from financing activities include those from the owners, cash received from the owners for stock issued, or cash paid to the owners either in dividends or buying back stock. Cash from lenders is when you borrow loans, and cash to lenders is when you repay the principal of the loans bought. Note that net cash used for financing activities indicates that you paid more dividends, paid back more loans, bought back more stock than you issued new stock or borrowed new loans. So overall, what happened? Cash decreased by $3.2 billion from the beginning of the year, which is the same as the end of 2013, to the end of 2014. Why? Even though you generated cash from operations, you used it to buy property and equipment and to pay dividends, buy back stock, pay back loans. Note that this ending balance of cash on the statement of cash flows agrees with the cash at the end of 2014 on the balance sheet. Notes are required for financial statements of publicly held companies like PepsiCo. They explain information in the summarized financial statement and provide details. PepsiCo's first note talks about the basis of presentation, including consolidating financial information for subsidiaries they control, even if they don't own 100%, and that they use generally accepted accounting principles in the United States. And this note gives results by division as well as for the whole company. There must be a note describing the significant accounting policies used for different transactions and financial statement items. Often, companies have the option. They can choose more than one acceptable methods and still be in compliance with U.S. generally accepted accounting principles. Here we have two policies for revenue recognition, revenue, and marketplace spending, which is a cost of selling, sales incentives, and discounts. Supplemental financial information is provided in Note 14. If you want to know more about the types of inventories, well, some of them are raw materials like sugar, while others are finished products like Doritos. The auditor's report contains the opinion of an outside accountant and about the fairness and presentation of the financial statements and footnotes in conformance with generally accepted accounting principles. PepsiCo has to have this done as a publicly held company that trades its stock on an exchange. Here for PepsiCo, the New York Stock Exchange. They have their auditor also examine that they have internal control over reporting to comply with the Sarbanes-Oxley Act. The audit report contains the following paragraphs. An introduction, the scope of the audit that they did to make their conclusions, their definition and limitations of their services, and most importantly, but shortest, their opinion on the financial statements and internal control over financial reporting. We will see this on the next page. The opinion paragraph for the auditor's report for PepsiCo is unqualified, which is a good thing. It indicates fairly presented financial statements using U.S. generally accepted accounting principles, highlighted in yellow, and that PepsiCo has effective internal control over its financial reporting processes. So, feel free to use this presentation as a guide before looking at other companies' annual reports for your discussion. Good luck and get started, Jaspers.